What really happened at the Jackson Hole Symposium? Well, we're breaking it down with Gary Wagner, editor of thegoldforecast.com. Gary, welcome back. I wanted to bring you back today because right before the symposium happened last week, we had talked about predictions, and you had expected that they would announce some sort of tapering, and you were correct there. You had also said that if their message is hawkish, the Fed's message is hawkish, then you would expect the dollar to turn bullish. Well, the dollar didn't turn bullish. In fact, the DXY fell following Jackson Hole. So what does this mean? Does that mean that their message wasn't very hawkish after all?
Because in the past, what they've really said, it's data dependent. And when the data suggests that it's time to taper, we will taper. If they actually come out now and put some sort of a timeline down, kind of like they've already done with the dot plot, I think that that could actually be bullish for the dollar. Well, first of all, a pleasure to be here today. I thought that the message was much more dovish. Yes, they announced some sort of a timeline for tapering, and I didn't think we would have such a concrete piece of information come out of that. And that, by any stretch of the imagination, is a more hawkish tone. They announced a liftoff date. However, my key takeaway was that Chairman Powell differentiated the criteria needed to begin to taper and the criteria needed to raise interest rates. Because if you recall, last time we had an extremely accommodative monetary policy, which started in 2010 through 2013, when they began to taper, the interest rate hikes came fairly recent in terms of the timeline between adjusting tapering and raising rates. And he went to great extremes to tell the public that there are two different criteria, and just because they're going to begin to taper doesn't mean that they're going to soon begin to raise rates.
But Gary, either way, the Fed didn't signal that they're going to buy more or ramp up their asset purchase program. So it's not like they're going to make monetary policy looser. They were just deliberating whether or not and when they would taper their asset purchase program. So why would the markets interpret this message as anything but hawkish?
Well, a couple of reasons. He announced a timeline when they believe they will begin to taper, but they didn't announce anything as to the amount they're going to taper each month. Right now, of course, there's purchasing $120 billion of assets each month. 80 is going into U.S. debt instruments and 40 is going into mortgage-backed securities. If they simply taper it by $1 billion a month, let's say, so that would simply take that 120 to 118 if they do it equally. And that's the other thing that he said, that they're looking for inequality in terms of tapering. In other words, they're not going to taper the mortgage-backed securities more aggressively than the U.S. debt or vice versa. They're going to taper them, and I believe it's going to be that 2-to-1 because their purchases are 2-to-1 favoring U.S. debt. The main reason I don't believe it was extremely hawkish, and it's why we saw gold move up after he had the virtual speech, is that he made it clear that what they're looking for is completely different in regards to raising interest rates and not tapering, because tapering is putting a massive amount of liquidity in the market. You saw the stock market continue to rise, so they interpreted keeping rates low as very, very dovish. And it was very bullish for the stock market. In fact, today we had new all-time highs in the NASDAQ and the S&P. We've seen that throughout the period between his speech and now. But it is the differentiation that I think was most important. And that's why I believe that he came off more dovish than the minutes had revealed from the last FOMC meeting.
Well, let's just get down to it, Gary. Do you think they'll taper it before the end of the year?
I believe they could easily have liftoff before the end of the year. The question is, see, their balance sheet.
Hold on. Sorry. Let's differentiate the two. Taper and liftoff. They're two separate things. So Powell is saying that he's likely to taper first and then raise rates, right? So I think he stressed that that's the order of operations for them. So given that needs to come first, do you think they'll taper first before the end of the year? Or are you saying that they'll do both before the end of the year?
I don't believe they'll do both. I think it is likely that they'll begin the tapering process maybe in November or December. But what we don't know is how much they will taper by. Are they going to taper from 120 billion to 100 billion? That would be a different sense that if they're tapering 5 billion off of each end, or 5 billion off of mortgage-backed securities and 10 billion off of the debt instruments, or 2 billion and 1 billion. The key is how quickly they're going to reduce their asset sheet, because if you recall, the Fed had swelled to $4.5 trillion on their asset sheet as they began to taper and actually start to liquidate, not taper, because they had already began the tapering process, but began to liquidate their holdings. They started at 4.5, and by the time they got to 3.75 trillion, they thought that that was causing an impact on the economy, so they let it sit. Now their asset sheet is well over 8 trillion. So tapering simply means adding less to that balance sheet. It's talking nothing about reduction of the balance sheet.
Interesting. Okay. Well, that's good to know. Well, what's going to happen to the dollar then, Gary?
All things being equal, and the jobs report is going to be significant, and that could change really the tone of my outlook. And we're living in a very fluid time where things are changing day to day. There's a huge unknown with the Delta variant. How much will it slow down the economic recovery that has been recently evident by strong GDP numbers in the United States? And so that's going to determine it. I do think it's quite possible that they will announce that they are going to begin to taper by the end of the year. I think it's highly unlikely that they're going to raise rates by the end of the year. And the only thing that would change that is inflation. I thought it would stabilize in this area, but maintain high. In other words, my sense was that it had less of a transitory nature than the Fed had maintained. And it's actually gone up. And so that is the key in terms of if their hand is forced to raise rates to bring inflationary rates down.
All right, so let's bring this back to gold now. I'm going to posit a theory. Feel free to disagree with me, Gary. And if you disagree, then please let us know why and what other thoughts you may have. I think that gold is going to stabilize and stay flat for the foreseeable future. For the next 18 months, it's going to keep trading range bound between 1800 to 1850 because the market has already priced in the tapering timeline and inflation expectations. What do you think?
I think that's a quite plausible assumption. My sense is that if it breaks above the current resistance area, which begins at 1827 to about 1835, 1835 is the highs of August, 1827 is a Fibonacci number. If it breaks above there, it has a real shot to trade as high as 1866, because that would be the next technical level of resistance. Now, of course, the brass ring would be breaking 1900 and 1920, which is the most recent high. I believe there is an opportunity to see gold move higher. I would look right now, what is key and critical is that as a result of Powell's speech on Friday, what we saw was a dynamic break above key and critical moving averages, meaning the 200-day and the 100-day. The 50-day sitting at about 1795. I look at that as a major support area. But it has now, for the last 3 days, remained above both the 200-day and 100-day. The second thing is the 100-day moving average has just crossed above the 200-day moving average. While in it of itself, that's not a reason to think the market is going to go up. I think that your assumption is quite plausible, but it is also plausible that we will see the market maybe test 1866.
Okay. I was really hoping you would reject my thesis outright and give us a completely bullish scenario, but you partly agree with me, you partly disagreed, so we'll see what happens. What about silver, Gary? Silver has also been stuck in a range. Now, I've talked to a guest about silver, and it's quite interesting what he said. He thought that silver is no longer going to track gold in the foreseeable in the foreseeable future. The correlation has broken down this year, as you know, and he thinks this divergence will continue as gold continues to be a monetary metal, while silver will lose its monetary crown and trade more like a base metal, more like copper. What do you think? Would you agree with that?
Well, there's definitely been a disconnect between price moves in gold and price moves in silver. In fact, even today, we saw gold move down a little bit and silver pop up. The other day, it was the opposite, but what we're seeing is they're not always moving in tandem. And for that reason, I absolutely agree there is a disconnect between the two metals in that they don't tend to run in tandem and have a high positive correlation in terms of the daily moves.
Okay. So what does that mean for the price going forward? Does that mean that if you think gold is going to be trading within a broad range, that silver could potentially run up much higher or even break down without having to rely on silver first, or gold first, rather?
Well, the one thing that we can look at in terms of historical data is when gold reached its all-time record high, August of last year, $2,088 per ounce. Silver ran, but it topped at $30, which was a new high for the year maybe, but it didn't come close to the $50 benchmark that we saw silver go to back in the middle of 2011 when gold ran to $1,920. We saw that $50 mark getting hit. So we're seeing that the effect of the breakdown in the economy due to the pandemic and then the recovery has made gold a lot more sensitive. And I would have to agree, it is silver not acting as much as a safe haven asset as reflecting industrial demand and usage.
Is the gold-silver ratio something you still even look at, Gary? It's currently at about 75. It went to an all-time high last year, and it's come down closer to historical averages, but not quite as low as 60, 50, which is what we've seen in the past.
My sense is I can't reflect this to the gold-silver ratio. I just think silver is not reacting as bullishly as gold to the basic fundamentals of what the Federal Reserve is doing in regards to their monetary policy. And that, to me, is the key.
What trades are you putting on this week?
Well, we went long gold at $17.95. We put the trade on one day prior to the Powell speech, but we also went long silver. And both of them are doing well now in terms of active trades. And as I've told my subscriber base, I do not expect silver, even if they both run to higher pricing, I do not expect silver to have higher percentage gains than gold. Whereas a year ago, typically when they ran higher, you always saw silver outperform gold in terms of a percentage gain. Reciprocally, when they traded under pressure to lower pricing, you saw silver lose more ground in terms of percentage drawdowns in gold. It's that disconnect that gives me some uncertainty as to how the two will work together in the future.
Okay, excellent. Well, Gary, thank you so much for your update today, and I appreciate it. We'll follow up again soon in a few weeks.
Thank you so much for having me, and have a great day.
You too, you as well. And thank you for watching Kitco News. I'm David Lin. Stay tuned for more.